Welcome back to Investing Talk Podcast.
Today we're looking at Tempus AI.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Tempus AI sits right at this critical juncture, between two of the biggest, fastest moving sectors out there, healthcare and artificial intelligence.
Right.
They are a recognized leader in molecular diagnostics and AI-driven precision medicine. So this isn't just a niche tech play, it's a structural one. And that really sets the stage for the kind of, explosive financial performance we've seen.
Structural and explosive. Those are definitely the right words. We're looking back at the Q3 2025 earnings.
The ones that really stunned the street.
Totally. They dropped revenue figures of, $334.1 million.
And here's what that means for you. That's an 84.7% increase year over year.
That is just massive velocity.
Mm-hmm.
And it sailed past the consensus estimate of, I think, around $328 million.
They didn't just meet expectations, they crushed them.
Yeah.
That kind of growth velocity is phenomenal for any company, really, but especially one that's scaling inside the highly regulated healthcare sector.
For sure.
But what really flipped the script for analysts, and what is maybe more important than the past quarter's numbers, is their raised outlook and, crucially, their shift toward profitability.
Okay, so explain that shift, because that's the inflection point everyone who follows high-growth companies watches for, right?
Absolutely. So Tempus raised its full-year 2025 revenue guidance to $1.265 billion,
Wow.
which implies annual growth near 80%. But the key is what happened on the bottom line. For the first time, adjusted EBITDA.
Which is basically a measure of their operational cash health.
Exactly. Before taxes and accounting quirks, it turned positive, $1.5 million for the quarter.
And you have to compare that to the prior year.
You do. Compare that starkly to the $21.8 million adjusted EBITDA loss they posted last year. This signals they are finally scaling past their huge operational overhead.
So they are generating enough operational cash to fund themselves, or at least come close, after years of burning through capital.
Exactly. It's the sign they are achieving true scale. And this operational discipline is confirmed by their adjusted loss per share narrowing to just 11 cents.
Which outperformed even the most optimistic forecasts. They're proving they can manage costs while still expanding aggressively.
And the analysts clearly noticed. The sentiment now is universally upbeat. They're forecasting sales growth above 20% even as we move into 2026.
Which is still incredibly robust given the scale they're hitting.
Right. And we're seeing specific buy ratings and high price targets from firms like BTI, H.C. Wainwright, and Canaccord. Targets are ranging pretty aggressively between $89 and $96.
That level of conviction is striking. But it can't just be based on one quarter surprise. It has to be based on why they're so uniquely positioned, their competitive moat.
Yeah, and Tempus has clearly built a serious defensible moat.
So what does that moat actually look like? I mean, we hear terms like deep integration all the time.
Yeah.
What makes them so hard to replicate?
It really comes down to data and workflow lock-in. They're leaders in advanced molecular profiling and AI diagnostics. Their tech isn't a separate tool. It's deeply integrated into biopharma research and, crucially, into clinical provider systems.
Hospitals, oncologists.
Exactly. Once a hospital integrates Tempus's tools for patient screening and treatment matching, the switching costs just become extremely high.
They become sticky customers.
And the centerpiece of that stickiness, the thing that pays for all the R&D, is their data platform, right?
That's their flagship offering, the Insights platform. It's the secret sauce.
It's not just about running a genomics test. It's a scalable, cloud-based intelligence system. It combines molecular sequencing data with clinical outcomes data.
So they know what treatments worked or didn't work for similar patients.
Precisely. And this massive structured data set is monetized by selling access to biopharma companies. They pay a premium because this data radically accelerates drug discovery.
Like a perfect virtuous cycle. Diagnostics generates data. Data generates revenue, which funds more diagnostics.
Exactly.
Okay, we need to balance this. Shifting to the financials themselves, they currently have a market cap of what, $14.7 billion?
Yes, which is a high multiple based on their trailing 12 months revenue of $1.1 billion.
That valuation is significant, especially given they're still not GAAP profitable. I mean, their TTM net loss is still large, $203 million.
It is, and we have to acknowledge that. But it's absolutely a valuation based on future potential, and there are, mitigating factors. That $203 million net loss figure includes non-cash items like stock-based compensation and depreciation.
Which is why that positive adjusted EBITDA number is so vital.
It is. It shows the core operations are healthy and moving in the right direction. For investors, the key is the trajectory.
And the trajectory, combined with their limited long-term debt, suggests the financial path is becoming a lot less risky.
That's the story. That cash discipline moving from a huge operational loss to a positive figure, it gives them tremendous flexibility. They have more control over their destiny.
Right. They aren't constantly forced to raise dilutive capital to fund R&D.
Precisely. They are converting that high growth into sustainable operations, which is the necessary bridge to full long-term profitability.
Let's pivot to what the market itself is saying through price action. This stock has been a massive winner this year.
Oh, absolutely. Year-to-date performance is up roughly 146%, consistently outperforming the broader market.
You have to wonder how much runway is left after a run like that.
It's a fair question. But even after that run, the momentum appears structural, not just euphoric. Shares consolidated pretty healthily near that $72 to $84 range.
We've seen resistance around $89 to $90, and some firm short-term support established above $70.
Which suggests stability at these higher levels. And what's fascinating is that the technical indicators seem to confirm that medium-term health.
So this isn't just a volatile flash in the pan.
That's right. The stock's been trading above its 50-day moving average since September, which confirms a sustained uptrend. And if you look at momentum indicators, the RSI is sitting between 54 and 60.
Which, for our listeners, just means the stock isn't overbought. There's still room for strong buying.
Exactly. And the MACD also remains bullish but not stretched. In plain English, the strong positive trend is still intact.
So institutional money is accumulating positions without overheating the price.
Right. Benzinga's edge rankings even put its momentum in the 90th percentile.
And that technical strength is being reinforced by some very big endorsements, the ARK Innovation ETF.
Which is very closely watched by the tech growth crowd.
They recently increased their stake significantly, making Tempus AI their fifth largest holding.
That's 4.6% of their portfolio. That's a serious institutional vote of confidence.
When you combine that technical stability with deep institutional backing, you see why the aggregate analyst rating is a consensus buy.
The median price target is around $78, $79, with the high end reaching up to $105. Professionals still see significant upside.
Okay, so strong fundamentals, trajectory towards profitability, great technical health. Let's talk about catalysts. What should you be watching for?
The biggest near-term event within the next 3 months is the Q4 2025 results. They're expected in February.
And the market won't just be looking at the headline revenue number.
No, that's expected to be strong. The focus will be on those crucial margin improvements. They have to prove that the positive Q3 adjusted EBITDA was a permanent shift, not a one-off.
And there's some market mechanics to watch too.
Definitely. Keep an eye on December 15th. That's when the Russell 2000 and 3000 ETF rebalancing impact will be felt.
Which often drives sort of mechanical buying from index funds.
Exactly. Then in early January, around the 5th, we'll get the institutional 13F filing updates, which show who was buying at the end of the year.
And beyond those dates.
Expect to see more announcements about their Insights platform and new biopharma collaborations.
Okay, here's where it gets interesting, though. The long-term and speculative buzz. And we should be cautious about unconfirmed rumors.
Absolutely. The long-term catalysts center heavily on M&A potential. There's ongoing speculation about partnerships with major global pharma firms.
Why? Because Big Pharma is trying to future-proof their R&D pipelines.
Right. Acquiring Tempus would give them an instant, unparalleled AI backbone for drug discovery. That kind of deal would be a massive validation.
And there are rumors about internal expansion, too, moving beyond their core oncology focus.
They are. Unconfirmed reports suggest they're preparing to enter new areas like neurology and infectious disease. If they can do that successfully, the addressable market just explodes.
And, of course, the ever-present buzz about a next-gen AI platform breakthrough.
Right.
We've painted a very bullish picture, but we have to bring it back to earth and discuss the risks. What should you, the investor, be worried about?
The primary risk, as we said earlier, is that the company is not yet profitable under GAAP rules. It continues to post significant net losses.
And that gap margin improvement is absolutely critical for the long-term viability of their current valuation.
It is. Investors need to see that GAAP profitability horizon clearly established soon.
And their business model itself requires massive investment just to stay ahead.
That's the R&D intensity risk. High innovation costs are standard for them, and those costs will continue to pressure margins if they aren't offset by rapid revenue growth.
If that growth rate slows faster than expected, margins will suffer immediately.
And finally, there's just the general sector risk. You're in both healthcare and tech.
Right. Even if Tempus's fundamentals stay strong, the sector is notoriously volatile.
That volatility can disproportionately hit high-growth valuations. Plus, you have ongoing threats from competitors in AI diagnostics.
So putting it all together, what's the summary? What's the investment thesis here?
The thesis remains, I think, overwhelmingly bullish. We're seeing a structural transformation in healthcare, and Tempus AI is right at the center of it.
I'd have to concur. The sources suggest an extremely strong outlook, maybe an overall rating near a 9 out of 10, given the exceptional growth, that crucial positive cash flow inflection, and the robust technical and institutional momentum.
It's attractive for both short-term investors, leveraging catalysts like earnings, and for long-term investors seeking exposure to that structural AI disruption in healthcare.
So the ultimate story here is Tempus AI's transition from being just another fast-growing startup to becoming an indispensable, scaled platform.
Yeah.
They've already shown the velocity.
Now the focus shifts entirely to durability and scale. They have to prove they can turn a great platform into a great, durable, and profitable business. And that successful conversion is where the real multi-year value lies.